OPEC's first monthly report since major oil producers began cutting their production showed that oil production from OPEC members dropped by around 890,000 barrels of oil per day to an average of 32.1 million barrels. Reuters says that this represents 93% of the pledged 1.16 million barrel cut that OPEC had gone for. At the same time, OPEC increased its forecast for world oil demand growth by 35,000 barrels of oil a day to 1.19 million this year. Now, what's all this mean? Well, if we take a look at the price of oil, we've got here a price of WTI, which is US crude. You can see that since the point at which OPEC went for that announced the cut in Algeria, the price has risen on expectations that they would abide by this. And you can see that compliance has been pretty good. And as a result of that, we've got this sideways movement. But today's trade, you can see that on the whole, the markets appear to be a little bit disappointed. Why? Well, because all this may mean nothing. Because despite the compliance with the production cuts, which should be pushing up prices, there's widespread market forecasts of a rise in US drilling activity. And you've got to remember that a lot of what the US is promising through the new regime of Donald Trump is that it'll bring back some of this shale oil, which is very easy to bring back on. It's very cheap and very flexible way of drilling for oil. So what's this mean for the price? Well, on the way down today for the daily, look at the hourly. You can see the way in which the markets have responded on an hourly chart. That was just before the release of this report. Since then, we've seen this dig deeper on down. In terms of some of the levels to watch out for, we're just trading around this red line here, which is the 200-hour moving average. You've got the blue here at 52.81, which is the lower level of support potentially. And you've got the green line, the upper SMA here, which is the 50-period moving average. But at the moment, at least, it looks like we could well see a continuation of this drop. Don't forget as well that on Friday we saw the oil field services provider Baker Hughes telling the markets that the number of rigs drilling for oil in the US increased by 8 last week, the 14th gain in 15 weeks. And that brought the total count to rigs active now to 591. And that's the most since October 2015, underlying concerns that the ongoing rebound in US shale production could derail efforts by other major producers to rebalance global oil supply and demand. So the outlook for prices, well, potentially on the way down from where we are at the moment, especially if the US does do what it wants to do and pump more oil.